In March of 2008, one of the most powerful investment banks on Wall Street ceased to exist. Not over years, not over months, in a matter of days. This is the story of Bear Stearns. And if you have money invested anywhere, a 401k, a pension, a retirement account, this story is about you too. Bear Stearns had been part of Wall Street since 1923. It survived the Great Depression. It survived Black Monday in 1987. It survived the dot-com crash. For 85 years, it had weathered every storm the financial world threw at it. By the mid-2000s, Bear Stearns was one of the 5 largest investment banks in America. It managed billions of dollars in assets. It employed over 14,000 people. And it was deeply, almost entirely trusted. That trust was about to be tested in a way nobody saw coming. Through the early 2000s, the American housing market was booming. Home prices kept rising. Lending standards kept loosening. Banks were giving out mortgage to people who, under normal circumstances, would never have qualified. And Wall Street found a way to turn all of that into a product. These mortgages were bundled together into complex financial instruments called mortgage-backed securities. They were sliced, packaged, and sold to investors all over the world. They carried high ratings from the agencies that were supposed to evaluate them. And they offered returns that looked very attractive. Bear Stearns went in deep, very deep. The firm had massive exposure to these mortgage-backed securities, and it had borrowed heavily to buy even more of them. This is called leverage, using borrowed money to amplify your bets. When things go well, leverage multiplies your gains. When things go wrong, it multiplies your losses just as fast. In 2006, the housing market began to crack. Home prices started falling. Borrowers who had been given loans they couldn't truly afford began to default. The mortgages at the bottom of all those carefully constructed financial products started to fail. In the summer of 2007, 2 Bear Stearns hedge funds that were heavily invested in these securities collapsed completely. Investors lost nearly everything. It was a warning sign, a loud one, but the firm kept going. Leadership insisted the core business was sound. Analysts maintained their confidence. The stock stayed high. And many people, including thousands of employees and retirees with savings tied to the firm, believed them. Then came March 2008. Word began to spread through the financial community that Bear Stearns was struggling. Counterparties, the firms and institutions that did business with Bear Stearns every day, started getting nervous. They began pulling their money, refusing to lend, demanding collateral. In the world of high finance, confidence is everything. And once confidence cracks, it can shatter in hours. On Monday, March 10th, Bear Stearns had approximately $18 billion in cash reserves. By Thursday the 13th, that number had collapsed to just $2 billion. In 3 days, the firm had essentially run out of money. That Friday, the Federal Reserve stepped in. J.P. Morgan Chase agreed to buy Bear Stearns, but not at its stock price of over $30 a share. The deal was struck at $2 a share, later revised to $10, but the damage was done. A company that had been valued at over $20 billion just 1 year earlier was sold for a fraction of that. The employees who held stock as part of their compensation saw it nearly wiped out. Retirement accounts tied to the firm were devastated. And the broader market, watching all of this unfold, began to understand that something far larger was unraveling. Bear Stearns was the first domino. Lehman Brothers would follow 6 months later. And the crisis that followed would cost millions of ordinary Americans a significant portion of their retirement savings. So what does this mean for you? The first lesson is this: risk is often invisible until it isn't. The mortgage-backed securities that brought down Bear Stearns carried high credit ratings right up until they didn't. Firm's stock looked stable right up until the week it collapsed. Many investors had no idea how much exposure they had to these products. because the risk was buried inside funds and portfolios they had trusted to professionals. That's not unusual. That's actually how most financial disasters work. The danger hides inside complexity, and it only reveals itself when it's too late to avoid it. The second lesson is about leverage. When a company or an individual borrows heavily to chase higher returns, they create a situation where there is almost no room for error. Bear Stearns was leveraged at roughly 35-1 at its peak. That means for every dollar of its own money, it had borrowed 35. A small drop in asset values was enough to make the entire structure unstable. You may not be running an investment bank, but the principle applies to anyone. High return opportunities that rely on borrowed money or complex structures carry risks that are easy to underestimate when markets are calm. The third lesson is diversification, and it goes deeper than most people realize. It's not just about owning different stocks. It's about making sure your retirement savings aren't all exposed to the same underlying risk. During 2008, many portfolios that looked diversified, different funds, different managers, turned out to be tied to the same collapsing market in ways that weren't obvious on the surface. True diversification means spreading across different asset classes: stocks, bonds, real estate, cash. It means not concentrating too much in any single sector. And it means periodically asking whether you actually understand what you own and what risks it carries. The fourth lesson is about the institutions we trust. Bear Stearns was 85 years old. It had survived every major crisis in modern financial history, and it was gone in a week. The size and age of a financial institution is not a guarantee of its safety. The reputation of a firm is not a guarantee that your money is protected. This is not a reason to distrust the financial system entirely, but it is a reason to stay engaged, ask questions, and not assume that someone else is watching out for your interests. Because in 2008, many people discovered that the institutions they had trusted and the advisors who had reassured them had not fully understood the risks either. The fall of Bear Stearns didn't happen because people were reckless or dishonest, though some were. It happened largely because the system had grown so complex, so interconnected, and so dependent on assumptions that turned out to be wrong, that when reality arrived, almost nobody was prepared. That's the most important thing to carry with you from this story. Markets can change fast. Risks that seem distant become immediate. Institutions that seem permanent can disappear almost overnight. And the people who fare best through those moments are the ones who prepared before the crisis, not during it. Review your retirement accounts. Understand what's in them. Make sure you're not overexposed to any single company, sector, or type of financial product. If something in your portfolio feels too complex to explain simply, that complexity may be hiding a risk you haven't accounted for. You don't need to predict the next crisis. You just need to make sure that when it comes, and history tells us it will come, your financial foundation is strong enough to survive it. Bear Stearns couldn't say the same. Make sure you can.